This market update is prepared based on the recent presentation of the Chief Economist of the National Association of Realtors, Dr. Lawrence Yun. Home prices are still holding on in significant areas in the country. Let's take a look at what is happening now and what to expect in 2023. The graphs will tell interesting stories. Mortgage rates shot up very rapidly this year. We did not have a gradual increase, but a sudden quick jump. From 1990, the interest rates were steadily trending downward, with some ups and downs, but generally going down. You see 10%, 8%, 7, 6, 5, and then 3% in 2020. And suddenly, this year, they jumped up. At the time we're shooting this video, the rates are about 6.5%. The question is, why over the last 30 years the rates were going down? Next graph will explain it. Let's make it simple. Low inflation, low mortgage rates. High inflation, high mortgage rates. So, to answer our own question, the main reason for the interest rates decline in the last 30 years was the fact that inflation was kept under control. What to expect in the future? Same logic applies. If the inflation rate declines, we can expect mortgage rates going down. And if inflation worsens, the mortgage rates will grow higher. Because of the high mortgage rates, we see that the number of sales in 2022 are falling throughout the year. The graph starts early 2020, right before COVID. And you see how with lockdowns, the number of sales initially collapsed, and then from summer 2020 all the way through January 2022, the market was pretty active. And this year, we see the number of purchase contracts going down, 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 as mortgage rates go up, up, up. Because of the higher interest rates, required income to buy a median home price in America went from about $50,000 of annual income to $85,000. These are nationwide numbers. For the San Francisco Bay Area, it would translate to the change from about $300,000 to close to $400,000 required annual income today. You would have thought that because buyers are not there making offers and buying homes, the number of unsold homes is becoming too big and the home prices will decline. The media predicts a 20% or even bigger price drop, similarly to the market crash that happened back in 2007-2009. Is it really going to happen? Let's look at this graph. It clearly shows how for the last 12 years the inventory of homes was going down. Definitely, with the up and down swings, but trending down. In the beginning, back in 2008 housing crisis, we had almost 4 million houses for sale. And today, even though buyers are not active on the market, and you would have thought that the number of houses available for sale would significantly increase, we have just 1 million houses for sale in the entire country. So from the basic supply and demand point of view, we don't have demand at the moment, but we also do not have enough supply. This is a serious factor that may slow down the fall of home prices or prevent a significant decrease. Bay Area market is slowing down faster than the rest of the country. While the countrywide home sale price increased by 6.3%, the Bay Area median home sale price dropped by 3.7% compared to November of 2021. Here in Santa Clara and San Mateo counties, we see a big mismatch between buyers and sellers' behavior. Sellers remember the peak spring sale prices and listed their homes 9.9% higher than last year. And it doesn't fly with the buyers, whose personal finances are affected by high interest rates, local layoffs, inflation, and general economic uncertainty. Many buyers put their home buying plans on hold. As a result, the number of homes sold in Santa Clara and San Mateo counties dropped by 53% comparing to last year, and the number of homes available for sale, active inventory, increased by 43%. Dr. Yoon shows the San Francisco market as an example of the home price decline. As one of the most expensive markets in the country, it is also more vulnerable to the interest spikes. With exactly the same interest rate increase, the additional monthly payments, for example, in Indianapolis, may be $300. In San Francisco, it would be $3,000. What is happening in San Francisco? Let's take a look at the office vacancy rates before COVID and after COVID. The graph shows Salt Lake City, New York, Chicago, Washington, D.C., and San Francisco. In all the cities, the vacancy rates today are higher than before COVID. It tells you that work from home arrangement is here to stay. But look at San Francisco. Look at the Delta. Today, they have 3 times more vacant offices than before COVID. People are leaving San Francisco. Dr. Yoon says that he will not be surprised if in this situation the residential real estate market in San Francisco will drop 10 to 15% in 2023. We're still on the edge, whether we're in the recession or not. This is a GDP measurement of everything we produce in the country. COVID lockdown really brought the economy to a collapse, and then economic reopening led to revival. Then it stayed positive until early this year it turned minor negative and stayed minor negative for 2 consecutive quarters. The third quarter data showed to be minor positive, and the fourth quarter could be either minor negative or minor positive. We will find out in a few weeks. But the point is that with a recession, we're still not out of the woods. If you want to see why the economy is on the edge, look at this. Real estate investments, which means home sales, home construction, anything related to housing, is down. Economy is on the edge. High mortgage rates are pulling the home sales down, and the falling home sales are contributing to the economy slowing down. If we're really in the middle of the recession, it would be the most bizarre recession of all time. The blue line, which shows the number of the advertised job openings, is higher than red line, the number of people looking for jobs. This situation, when blue is higher than red, implies a very unusual economic recession. We see advertised jobs openings at restaurants, hotels, nursing homes, police offices, truck drivers. Apparently, it is not easy to match people who lost their jobs with the current openings. If an IT professional lost his job, it is very unlikely that he will take a new job as a cashier register at a grocery store. He probably will take his time to find a suitable job. Still, overall, it is very, very unusual to have a higher number of openings than the number of unemployed. We have a record high number of unemployed people on W-2 salaried payroll jobs. After a big drop during COVID lockdowns, the number of payroll jobs was steadily growing, and today they're at record high. This chart tells us that people think that the economy sucks. It is based on a survey by the University of Michigan. Looking at it, you can clearly see that the overall people's opinion about the economy is very unfavorable. People clearly say no, it is not a good time to buy. The chart reflects a very pessimistic view on buying a house at this time. But the curious thing is that people's opinion do not match up with their actions. For the last 2 years, people say it is a bad time to buy, and they get more and more negative about the idea of buying the house. But during the last 2 years, the real estate market was booming. And finally, here is a very strong argument about long-term prospects on the housing market viability, the steady population growth. Everyone needs a roof over their head. Whether rent or own, we all need to live somewhere. So even though we're having short-term fluctuations, the need for housing will only grow. Back in 1970, $23,000. In 2020, $300,000. Projected to reach $600,000 by 2050. It brings me to the point we always articulate to our buyer clients who are asking if it's a good time to buy. We say, if you plan to own this house for at least 5-7 years, then the answer is definitely yes. Go for it. If you may need to sell sooner, then there is a chance that you may get caught in a short-term downward market cycle. If you want to discuss your specific situation and decide on the right time to buy, call us at the number below. Together, we'll analyze all the factors, external and personal, to help you plan your next real estate move.